the Fed today?
I mean, rate cuts are coming. Rate cuts are coming, and that is extremely good news for markets, and that's why we're seeing this broad cheer across all the different markets. And Scott, one thing we said in the beginning of the year is this is likely to be a year of a broader opportunity set if the Fed cuts rates, and here we are. And what we see across the board, you see bonds rallying, you see stocks rallying, you see tech rallying, along with some of the rotation trades. So I think it's really, really good news. And September, even though Fed Chair Powell didn't say it, is the base case, and the markets are clearly gearing up for that.
I mean, there are suggestions. Look, some just straight up saying it, like Jeffrey Gundlach just did, that the Fed's always late. Yeah. And they're going to be late again, and history has proven that out. They're going to be too late to cut, and the labor market and the economy are weaker than people think.
Look, that may be true, but I think what he also said is they have a lot of room to catch up. And I do agree with Jeff. I also agree with Steve. I think that's one of the most critical questions for the markets right now. It's not about September, but how much more is the Fed going to cut and how quickly? If you look at the markets, they're anticipating that we actually get 3 rate cuts towards the end of the year, about 100 basis points into the end of next year. So if Jeff is right and we get something close to 150 basis points, even if they're behind, let's say, a month or two, I think that still propels the markets higher.
Even if it's for, I mean, look, he says that because he thinks it's going to be, these are my words, not his, obviously, for the wrong reason, that they have to cut that many times because, as he said, the economy's weak.
Yeah, I think, but if they make those moves in a decisive fashion, they could probably save the economy, so to speak. And Scott, there's nothing broadly that's wrong with the economy, but there are pockets of weakness. And the pockets of weakness, for example, you see defaults, delinquencies for some of the smaller companies go up significantly. You see high yield default rates that are rising. But I think if the Fed eventually acts decisively, they can stop that. The reason why I think this is such a big deal for markets, it's not just a sentiment boost, but this is actually the boost to the bottom line of the companies. And if I think about the consumers, the fact that you might be able to get an auto loan that is a lot cheaper or a mortgage loan. If I think about a middle market company that had to stomach the pressure of higher rates, this is a really big deal.
Okay, so what about the rotation trade? What happens to it now that the Fed has set the table, as we've been saying, for what probably is going to happen in September?
I think it's on. I think the investors should be squarely focused on the beneficiaries, again, from the fundamental standpoint. So that's why I still think regional banks is one of the best rotation trades out there. There's so many benefits from the steeper yield curve, as well as small caps and utilities. Defensives actually outperform post-Fed cuts. Yeah.